Hi everyone, welcome to chapter 13. In this class we are going to discuss how to value stock options using Black-Scholes Merton model. So before we go into the PowerPoints, because the chapter has a lot of basics that it doesn't discusses, so it directly assumes that you have information, like you have knowledge of log normal distributions, normal distributions, first order derivatives, etc., but you may not have that. So that's the reason I'm going to explain it in an Excel sheet first. We are going to do some problems and then we'll go back to the PowerPoint and then discuss it. So what is the basic thing? So stock basics means, like, the basic thing about stock that you need to be aware of is stocks follow log normal distribution. Now what is a log normal distribution? So first of all, what is a normal distribution? So let's go to Google and let's see normal distribution. Okay, so if you do an image, so this is what a normal distribution look like. Okay, so this is a normal this is what a normal distribution look like. What does a normal distribution mean? That if you know mean, so u is this mean, so if you know mean, most of the observations would be scattered around mean. So there is very low chance that observations will be away from mean. Most of the observations will be scattered around mean. So this is normal distribution. So if you know the mean, most of the observations can be estimated around the mean. There will be very few observations that will be away from mean. So what does that mean in terms of stock? So in terms of stock, it means, so if you're looking at Apple and you know Apple has a mean of 30%. Now what is mean? Mean is arithmetic or geometric average. Mean is arithmetic or geometric average. So if you know that Apple has a mean returns of 30%, so in any given year on an average Apple gives return of 30%, then, and you also know the standard deviation. So let's say standard deviation of Apple is 20%. So 30% is the mean, standard deviation is 20%. What is standard deviation? Standard deviation is deviations away from mean. Standard deviation is deviations away from mean. It is nothing but risk of stock or volatility of stock. Risk of stock or volatility of stock. So if you know these two things, mean and standard deviation, then you can estimate the returns that Apple will give. Okay. So based on normal distribution and also log normal distributions are similar to normal distributions. The difference is log normal distributions put more weight in recent events. Normal distributions put equal weights in all events. So log normal distribution of stocks means stocks have more weight to news that are recent, less weight to news that are in past. So that has taken more time, which is logical too. Apple will react more to current things rather than what has happened in the past. So if you know mean and standard deviation, the rule of log normal distribution says with 95% probability, with 95% certainty, you can say that stock returns will have a lower range and a higher range. So lower range will be given by mean minus 1.96 times standard deviation, and higher range will be given by mean plus 1.96 times standard deviation. Okay. So with 95% probability, you can estimate that lower range of a stock will be this, and higher range of a stock will be this. Now this can be predicted for stock prices. This can be also predicted for stock returns. So prices can be given you in dollar amounts, or it can be given to you in percentage returns. So in this case, we are looking at percentage return. So with 95% probability or 95% certainty, you can say that Apple's returns would lie in the range of 30% mean minus 1.96 times standard deviation of 20%. So minus 9.2%, and 30% mean plus 1.96 times standard deviation, so 20%, so 69.2%. So in any given year, Apple's return will range from minus 9% to 69%. Okay. Now this is a very crude way of doing it. Actually, it means and standard deviations, there is a method to find it out. So we are going to look at what are the methods to do it. Okay. So stocks follow log normal distribution. So if mean and standard deviation is known, with 95% probability, you can predict that range will be plus or minus 1.96 deviations from the mean. So lower value minus, higher value plus. Now how to do it in real life? So there are two methods, there are two formulas. So first formula is if stock is given in dollar terms. The second formula is if returns from stocks are given. So if stock values are given in dollar terms, this is the formula that we use. If returns are given, this is the formula that we use. So first let us discuss this formula. So what does this formula mean? So this formula means that log normal of a stock has a mean of natural log S0 being the current stock price. Okay. So ST is stock price in future. So log normal stock price in future will have a mean of log normal S0, that is log normal of current stock price, plus U, that is expected returns, minus sigma, that is volatility, times square divided by 2 into T. Okay. So log normal of stock will have mean of this. Log normal of stock, where U is expected return, sigma is volatility, not standard deviation, it's volatility. Okay, and T is time. So given expected return, volatility and time, you can find out what would be the average returns the stock should give in the given time frame. Now once again, this is log normal of stock price. This is not stock price. So once you find out log normal, then you have to convert it to normal stock price. So we are going to do that. And this also suggests that at any given point of time, the standard deviation is square root of sigma to the power 2 times T. Okay. So log normal stock standard deviation is square root of sigma times 2, sigma to the power 2 times T. Okay. So this is the formula. We'll understand it more when we use it. So let's say S0 is given 40. So stock price currently is $40. Expected returns on the stock are 16%. So that is your U. Volatility is 20%. That is your sigma. Okay. And time is given to be 6 months. So that is 0.5. They are asking you, predict with 95% probability what will be the stock's upper limit and lower limit. So 95% probability, what would be the range the stock would trade at in 6 months time. So ST is after 6 months, what would be the price. So how to do it? First, we find out log normal stock mean and standard deviation. Then we find out log or normal upper limit and lower limit. And then we convert this log normal to normal stock price. Okay, so let's do that. So log normal mean is given by this formula. So log normal stock price, so 40. Okay, plus U is 16%, the expected return, minus sigma 20%, okay, squared, so to the power 2, divide by 2, okay, times t. T is 0.5, 6 months. So we found out mean, natural log mean. We can also find out natural log standard deviation. So it is square root of sigma squared times t. So 20% to the power 2 times 0.5. So it is 1.14. Now you can find out range of log normal stock. So upper value is mean plus 1.96 times standard deviation. Okay, upper value is mean plus 1.96 times standard deviation. Lower value is mean minus 1.96 times standard deviation. Okay, so this was natural log. We don't want natural log, we actually want stock price. So we have to convert that natural log to normal function. So if you want to convert natural log to normal function, you do an exponential function. So exponential for $56 and exponential 3.48, $32. So within 6 months, this stock, like in 6 months, this stock should trade in between $32 and $56. With 95% probability, you can say this stock will trade between 32 and 56. So this is how you do it when stock price is given. So let's do one more problem, right? And then do it. So let's say stock price is 50, expected return are 8%, volatility is 10%, time is, let's say, 1 year. So how would you find it out? So steps to do it: first find out log normal mean, log normal standard deviation, find out log normal upper limit, log normal lower limit, and then convert it to normal stock. So how to do it? So first mean. Log normal mean is given by natural log stock price 50, okay, plus U is 8% minus sigma squared by 2, okay, times t, 0. Times t. T is 1 in this case. So it is log normal $50 plus 8% minus 10% to the power 2 divided by 2 times t. Okay, so it's 3.99. Standard deviation, if you calculate, it will be square root of volatility squared times t. So volatility squared times t. T is 1. So 0.1. Okay. So upper limit will be 3.99 plus 1.96 times sigma, and lower limit will be 3.99 minus 1.96 times sigma. So this was in log normal. We need to find it in normal stocks. So you just take an exponential. So exponential of upper limit gives stock upper limit, and exponential of lower limit gives stocks lower limit. So within 6 months, this stock should trade at $65 or $44. Okay. This is how to solve it when stock prices are given. Now let us look at how to solve it when returns are given. How to predict the stock returns. Okay, so let's talk about when returns are given, how to find out where will the stock returns lie in. So same process, except the formula changes now. So when returns are given, so let's say returns from a stock are 17%, volatility of stock is 20%, and time is given to be 3 years. Then how to do it? What will be the stock returns in 3 years? So you have to first calculate mean. So mean is U minus sigma square times 2, okay, into T. So let's take time 1 because it will become complex. So let's do it with time 1. Okay. So mean has U minus, because it's a multi-year return, then it's a different calculation. So method is same, but the interpretation will be different. So let's say volatility is 17%, returns are 17%, volatility is 20%, and time is 1. The formula for calculating mean is U minus sigma squared divided by 2 into T. Standard deviation is square root of sigma to the power 2 into T. Okay. And you can find out natural log you can find out mean, standard deviation, then you can find out range, right? And then we convert natural log to normal. So let's do that. So instead of stock, we are finding out return. So let's find out how to do it. So let's say this thing is given, 17% is the return, volatility is 20%, and time is 1. So first is, how do you find out mean? Log normal returns mean. So instead of ST, it is ST by S0 because we are looking at returns. Okay. So mean is given by U. U is 17%. Okay. Minus sigma. Sigma is 20%. Okay. Divide by 2. Sorry, sigma to the power 2. Divide by 2. And whole bracket times time. Okay. So it's 0.15. Standard deviation will be, standard deviations will be square root of sigma square, so 20% square times T. Okay, so it is 0.2. So you can find out upper limit, 0.15 plus 1.96 times T times standard deviation. So mean plus 1.96 times standard deviation is the upper limit. Lower limit is mean minus 1.96 times standard deviation. So the return should range between minus 24% to 54%, but it is log normal. So we find out exponential to actually get returns. So exponential of this is upper limit and exponential of this is lower limit. Okay, so one major thing is we don't have to do that actually. So since the returns follow log normal distribution, you can assume that returns will fall in this range. So you don't have to take a log normal thing, like you don't have to raise it to the power exponential to do it. So it's only two steps. First, find out mean, right? Standard deviation in log normal form, then find out range. So range of because it is in percentage, so you don't have to take a exponential of that. So limit will be 54% to 24%. If you see it in percentage, the stock should return 54% to 24%, right? This would be the limit of stock. The returns in this coming year would range between minus 24% to 54%. So let's do one more. So assume I'm deleting this. So let's assume the returns are 9%. The volatility of stock is 7%. Time is, let's assume, 1. Okay. So first step, find out mean. How to find out mean? Use this formula. So U is returns minus volatility squared divided by 2 times T. Standard deviation, square root of sigma square times 2 times 1. Okay, time was 1. So you know standard deviation, you know mean. So you can find out upper limit. Upper limit is mean plus 1.96 times standard deviation, and lower limit is mean minus 1.96 times standard deviation. So range is minus 5% to 7%. Range is minus 5% to 7%. Okay. So this was the first part. So if you know mean and standard deviation, whether it is stock price or whether it is stock return, you can find out range. Next is the concept of historical volatility. We have seen to calculate mean, standard deviation and ranges, you require volatility. So there are two ways to find out volatility. Volatility can be historic. So based on historical data, you calculate volatility, or volatility can be implied. Implied means from option prices you can calculate volatility. So first we are going to discuss how to calculate historical volatility. So the method to do it, I'm not going to follow what's given in the book, because on Excel there are easier ways to do it. It doesn't exactly match the book's way, right? But it is little bit easier, but the answers are very close. You don't have to really struggle like the book says. Like book has a lot of formulas in it, which is not that needed. So what you have to do, take observations of stock prices. So these are the stock prices, closing stock prices every week. Let's say we are doing it for 15 weeks. So closing stock prices every week. Okay. Then calculate continuously compounded return for each period. So how to do that? Continuously compounded returns are calculated using formula U returns equals to natural log the current stock price divided by previous stock price. Then calculate standard deviation of returns, okay, that you have calculated. Then calculate historical volatility, which is given as sigma, right, the S that you calculated, standard deviation, divided by square root of T, where T is 52 weeks are there in a year. We are discussing the one observation is 1 week. So sigma is 1 by 52. So let's do it so that you understand. So first step, take observations, plot it in a chart like this. So 15 weeks are given. So I am putting out observations for 15 weeks. Then step 2, calculate this value, row value, right, and keep it. So it is 1 divided by 52. We are going to need it. So I am keeping it somewhere. Okay. Then calculate continuously compounding returns. So continuously compounded returns are given by, so first period there isn't any return because you're just starting. Second period it will be log normal, this divided by previous value. Okay. So it is 5.79. Next period's return will be log normal, this divided by previous value, negative 2.35, and so on and so forth. So I'm just going to drag it. Okay, so this was step 2, finding out continuously compounded returns. Step 3 is finding out standard deviation. Now, there is a long process given in the book to calculate standard deviation. Now, actually that's the right process, but it takes too much time, right? There is an easier approximate way to do it. It's not as accurate as what the book suggests, but it is close enough. So how to calculate standard deviation? So to calculate standard deviation, we use standard deviation formula and we use sample formula, not standard deviation V, we use standard deviation S. So this STDV S. So double click that, it will have a range. So click on the first column, click on the, drag it to the last column. So standard deviation is 2.884. So if you look at the way they have done it in the book, it will come to somewhere around 2.78, 2.71, something like that. So it's very close, not much difference. Okay, so we calculated standard deviation, that was step 3. Okay, fourth step is calculate historical volatility. That is what we wanted, historical volatility. Historical volatility is given as S, okay, divided by square root of this variable, this row variable that we calculated. So volatility of this stock is 21%. Okay, volatility of this stock is 21%. So once again, how to do it? Take observations, arrange them in a table. Okay. Step 2, calculate continuously compounded returns in each interval. So returns will be given. So log normal of current stock price divided by previous stock price. Why didn't we find out anything here? Because the price in week 0 is not known. So we can't find it out. So we start from week 2. So week 2 will be natural log 32 divided by 30.2. Then it will be natural log 31.1 divided by 32, so on and so forth. So we found it out continuous return the stock has given. Then we compute standard deviation. So I am not following the book's process, it's too complex, right? So standard deviation dot S, right? It's an approximate way. Excel is an approximate way. So we found out standard deviation by selecting the first cell and dragging it till the last. Okay. Then we find out historical volatility using this formula. S, the standard deviation that you have found, divided by square root of row. Row is weeks, so 1 divided by 52. If it was day, it will be 1 divided by trading days. So let's say there are 240 trading days, so 1 divided by 240. We do not consider calendar year. We consider trading days. Okay. Now this is the process to calculate historical volatility. Now the important part, the Black-Scholes Merton model. So there is a long derivation given in the book. You will never be asked what is the derivation. Like I have done my CFA, Black-Scholes Merton model is a big component of CFA, especially level 2 and level 3. But no one will check derivations, and even in the book the derivation becomes extremely complex because you have to use log normal functions first, then take first order derivatives, then take second order derivatives to derive this Black-Scholes model. But you need to know how it is derived. So it is Black-Scholes model is created by creating a portfolio which has stocks and options, right? In stocks you go long, on options you go short, and then you try to compare, like the return should be similar. Right, so you find out the delta of the stock, then you find out the equation, then you create it. So not important, but you need to understand how to apply it. So we are going to discuss how to apply Black-Scholes Merton model. Okay, So how to apply Black-Scholes Merton model? So what is Black-Scholes Merton model? So call option price. So please pay attention. Call option price is S0, stock price right now, into N into D1, which is probability of stocks, right? Minus K, right? Exercise price of the option, e to the power R by T. R is risk-free rate, T is time, into ND2. ND2 is probability of exercising. ND2 is probability of exercising. ND1 is probability of stocks prices changing. So call option is calculated as S0 N D1 minus K e to the power R by T, right, and D2. Put option is calculated as K e to the power R T N minus D2 minus S0 N minus D1. Okay, and first D1 and D2 you have to find out. So D1 is log normal S0 by K plus R plus sigma square by 2 T divided by sigma square root of T. So this is D1. D2 is ln S0 by K plus R minus sigma square by 2 times T divided by sigma by T. Or you can find out D1 first and just subtract sigma by square root of T to find D2. Okay. I'll note down what variables we are going to use. So S0 is current stock price. Okay. Then we require R. R is risk-free rate. Then T is time. Okay, T is time. Then we require K. K is exercise price. K is exercise price. Then we require, what else is there? Sigma. This is sigma. Okay. That is volatility. So using these variables, we are going to calculate option prices. So put everything in, right? And then calculate call and put price. So we're going to do those examples so that you will understand. So I'll just copy this, move down. First, let us do the first problem first. Okay. We need this formulas, so I'll keep it here, and I'll tell you the steps too. So step 1, find out D1, calculate D1. Okay. Step 2, calculate D2. Once you have D1 and D2, step 3, they are asking you call option in this thing. So calculate call option price. If put option was asked, you will calculate put option price. So let's do that. So an example I have taken. What is the price of European call option on a non-dividend paying stock? First of all, Black-Scholes Merton model in this form can only be applied on a non-dividend paying European option. Okay, it cannot be applied on a dividend paying European option, or we have to make some changes, or it cannot be applied on an American option too. Okay, American calls are similar to European calls, so values will be same, but there is no way of calculating values for American puts using Black-Scholes model. Okay, so that was just information that you need to be aware of. So let's discuss what is the price of European call option on a non-dividend paying stock when the stock price is 52 bucks, the strike price is $50, and the risk-free rate is 12% per annum, the volatility is 30% per annum, and time to maturity is 3 months. So we are going to use these formulas to calculate. So let's do it. So let's calculate D1 first. D1, this formula we have to use. So natural log, okay, so natural log, what is the stock price? S0. S0 is current stock price, that is 52, okay, divided by exercise price. Strike price is exercise price, so that is 50, okay, plus I'm putting this in a bigger bracket because we have to then divide also, plus let's start a new bracket, R risk-free rate, so 12%, plus volatility sigma 30% squared, okay, by 2 times T. T is 3 months. So 3 months will be 3 divided by 12 or 1 by 4. So let's do 3 divided by 12. So let's calculate 3 by 12 first. 3 by 12 is 0.25, so that it's easier. So 0.25. 3 months is 3 by 12, 0.25. So this was the top bracket. Log normal, stock price 52 divided by 50 plus 12% plus 30% squared divided by 2 times 0.25. Now you have to divide this by sigma and square root of T. So it will be sigma 30% times square root of T. What is T? 0.25. Okay. You solve this, it comes to 0.5647. Okay, so we know D1. You can calculate D2. D2 is D1 minus sigma into square root of T. I'm not using this formula again, I'm using the shorter way. Once you have D1, you can calculate D2 by using formula D1 minus sigma square root of T. So D1 0.53647 minus sigma 30% volatility times T. T is times square root of T. So square root T is 0.25. So you have D1 0.53, you have D2 0.38. Now you calculate call option premium using this upper formula. So let's put it. So it is 50. What is the stock price? So stock price is, formula is S0 into N D1 first. So stock price is 52 into normal distribution so there is with this formula, I guess. Yeah, don't need this one. So the formula for N1, so let's calculate N1 and N2 first and then go back to this formula. So let's do N1 and ND1 and ND2 because you have to use a log normal formula. Okay, so how to find out ND1 and ND2? Two ways. At the end of the chapter, they have given values of ND1 and ND2 based on these numbers, or you can do it on Excel. You don't need this. Yeah, so norms distribution, this is the function. So that's why I was trying to put a dot, but norms distribution is the function to calculate ND1 and ND2. So norms distribution, right? D1 we know, so it is N of D1. So normal distribution of D1 0.7. Okay, and normal distribution of D2 is 0.65. So we know ND1, we know ND2. Okay, so let's put it in formula. So call option C will be this formula: 52 current stock price multiplied by ND1, okay, minus exercise price 50 into exponential. So E is given, risk-free rate 12% times T is 0.25. Okay, 0.25, and this whole multiplied by ND2 0.65. So if you solve this, the call option is 0.057 or 0.56. Okay, so steps to use Black-Scholes Merton model: calculate D1 first, okay, using this function. Okay, calculate D2 first. D2, then I use the shorter ways: D1 minus sigma square root of T. Calculate normal distribution ND1, ND2, because you need it in this formula. So ND1 is calculated using Excel function, or you can refer the book. It's much more complex to use the tables. So I use normals distribution, NORMS distribution of D1 and NORMS distribution of T2. So I found out ND1 and ND2. Then use this formula: S0 into ND1 minus K e to the power R minus RT, right? Minus RT times ND2. So that is call option price. So we are going to do one more problem for put option price. So formulas are similar, steps are similar, except the put formula is different. Instead of using this formula, we are going to use this formula. So let's do that. Okay, so next question is calculating European put. So same steps. So step 1, calculate D1. Step 2, calculate D2. Instead of call option, we'll have put options. But we need N minus D1 now, because it has N minus D1 and N minus D2. So instead of using N D1, we are going to use N minus D2 and N minus D1. Okay, and finally put option price using that whole formula. So let's do it using steps. So step 1, calculate DN1. So before that, what is given? The price of European put option on a non-dividend paying stock when the stock price S0 is given 69. So S0 is 69. Strike price 70. So K is 70. Risk-free rate is 5% per annum. Volatility is 35%. So sigma and R are given. R is 5%. Sigma is 35%. Time to maturity is 6 months. So 6 months is 6 divided by 12. So 0.5. So first we'll calculate D1, then D2, then we'll calculate ND1, ND2, then we'll calculate put price. So let's first calculate ND1. So formula for ND1 is, I'll open a bracket, natural log 69 is the stock price divided by exercise price 70 Okay, so the first bracket plus R is 5%, risk-free rate is 5%, plus sigma square, so 35% squared, okay, by 2, and this multiplied by T. T is 0.5. Okay, so this was first bracket. All brackets are closed. Yeah, divide this by volatility sigma, so 35% times T, 0.5, square root of 3, sorry, it's square root. Okay, 6QRT square root of 0.5. So if you solve this, it is 0.166 something. Let's calculate D2 now. D2 is D1 minus sigma, so 35%, times square root of T, 0.5. So D2 is negative, so let's do it in percentage, negative 8, it doesn't matter whatever values you get, and 16.66. So this is given. Now we have to calculate normal distribution function D1 minus D1 and normal distribution function minus D2. So let's do that. So normal distribution, okay, negative D1, so 0.43, okay, and normal distribution negative D2. Sometimes it does that. Normal, I'll just drag the formula down and change the value. Okay, negative D2. Okay, so we need to put a negative sign. So negative D2 was minus 8, so negative minus 8, so 0.53. Now we know D2 and D1, so let's calculate put option. So put options formula is this. So first bracket, K is exercise price, that is 70, into exponential negative risk-free rate 12% times T is 0.5. Risk-free rate is not, sorry, it is 5.5%. Risk-free rate in this problem is 5.5%, in previous it was 12, so that's why. So risk-free 5% actually, not even 5.5, 5% times 0.5. Okay, this was the first bracket. No, before that, so it's K e to the power minus RT, we have done that, K 70 into exponential e to the power minus RT times ND2, so this is ND2. This was the first bracket. Then we subtract. S0 is the stock price right now, 69. Stock price right now is 69, if I'm not wrong. Yeah, 69. Okay, times 69 times ND1, N minus D1, that we already calculated. So this is the formula, 70 into exponential 5% into 0.5 into 0.53 minus 69 times 0.43. So it is 6.40. So this is how you use Black-Scholes Merton model to calculate call option prices and put option prices. So with this knowledge, let's cover the PowerPoint. We're going to just discuss the main points. So Black-Scholes Merton model random walk assumption. So consider the stock price as in a short period of time, delta T, the returns on the stock will be change in stock price divided by the stock price right now is assumed to be normal with a mean of U times delta T and a standard deviation of sigma times square root of delta T. U is expected return and sigma is volatility. So what it is saying that stocks are randomly distributed right around mean and standard deviation. These assumptions imply log normal ST is normally distributed with a mean right and standard deviation of this. Because the log normal of ST is normal, ST is going to be log normally distributed. So we saw this for way. So log normal of stock price lies in this range, right, with mean of this and sigma of this. Log normal of returns lies in this mean and standard deviation. Okay, this is how a log normal distribution look like. Okay, so these formulas are not very relevant. So expected return, expected value of stock price at time t is S0 e to the power u by t. The return in short period delta t is u delta t. But the expected return on the stock with continuous compounding, we found it out. So expected return is u minus sigma square slash divide by 2. This reflects the difference between arithmetic and geometric mean. So whenever you're discussing stocks, whenever you're considering stocks, always use geometric mean. Okay, and this is, the book also states that this is a problem with mutual funds. Whenever we state mutual funds return, we discuss arithmetic mean, which is higher than geometric mean, but we have to look at geometric means whenever we are investing in mutual fund. So that was just a side discussion in the book. The volatility of an asset is standard deviation of its continuously compounded rate in 1 year. So standard deviation of returns in time delta t is volatility into square root of delta t. If a stock is $50 and its volatility is 25%, what is the standard deviation? So standard deviation of price change is 25% volatility into square root of time, that is 1 day. Volatility is usually much greater when the market is open. So this is a very important discussion that the book has, that volatility of a stock is higher when stocks are traded. So let's say Monday to Friday, when stocks are traded, the volatility will be high. On weekends, the volatility is low. Okay, for this reason, time is usually measured in trading days, not in calendar days when options are valued. The assumption is there are 252 trading days in a year. So instead of 365, we use 252. Suppose it's 1st April and an option lasts to 30th April. So the number of remaining days is 30 calendars or 22 trading. We look at 22 trading. We do not look at calendar years. So time to maturity will be 22 divided by 252, not 30 divided by 365. We discussed that how to calculate volatility from historical returns. You arrange them in order, calculate U, calculate standard deviation using Excel, which is easier than using the way the book has mentioned, and then calculate volatility using standard deviation divided by square root of T. The option price and stock price depends on the same underlying source of uncertainty. We can form a portfolio consisting of stock and options, which eliminates this source of. So Black-Scholes model is constructed by using stock and option. So you create a portfolio that gives you risk-free rate by going long on a stock and going short on equivalent number of options. The portfolio is instantaneously riskless and must instantly earn the risk-free rate. So this is Black-Scholes Merton model. Call option is given as S0 and D1 minus K e to the power R by T and D2. Put option is given by k into the power into e to the power minus rt into nd minus 2, like normal distribution of negative d2 minus s0 n minus d1, where d1 is log normal s0 by k plus r plus sigma square by 2 times t divided by sigma square root of t, and d2 is log normal s0 by k plus r minus sigma square by 2 times t into sigma square root of t, or easier way to do it, d1 minus sigma square root of t. So what is nx function? So this n function that we are looking at, nx is the probability that normal distributed variable with a mean of 0 and standard deviation of 1 is less than x, right? So to find out the normal distribution value, you can use book. So at the end of the book, there is normal distribution tables, or you can use normal distribution function in Excel. As S0 becomes large, C tends to S0 minus K e to the power T, and P tends to 0. Okay, as S0 becomes very small, C tends to 0 and P tends to be K minus R to the power T S0. So what happens when sigma becomes very large and T becomes very large? So what they're discussing is, as the stock price goes up, right, call option increases, put option goes to 0. As stock price goes down, put option increases, call option goes to 0. As volatility increases, both call and put increases. As time increases, both call and put increase. Risk neutral valuation, the variable u does not appear in Bloch-Scholes model. The equation is independent of all variables affected by risk preference. This is consistent with risk neutral valuation principle. Understanding Black-Scholes model. So this is the revised formula, right? So you can also represent Black-Scholes model using this formula. I don't suggest you do it. The earlier one, the step-by-step method, is much easier than using this. So assumptions that go into Black-Scholes model: assume that expected return from asset is risk-free, calculate the expected payoff from derivative, discount at risk-free. So payoff is ST minus K. So this is forward contract with risk neutral valuation. So present value is exponential R by T S0 e to the power RT minus K, which is nothing but, we have discussed this in future pricing. Future price is S0 minus K to the power E R by T. Now this is important. So there are two volatilities: historic volatility, which you can calculate based on data, or there is implied volatility. Implied volatility means based on the option prices, what volatility is implied, what volatility is implied, what you can calculate the volatility. So implied volatility of option is the volatility for which Black-Scholes model equals the market price. This is 1-to-1 correspondence between price and implied volatility. Traders and brokers quite often quote implied volatility rather than dollar prices. So that's why we have a VIX index. VIX is volatility of S&P 500, right? Most common call options and put options. So they combine it. VIX index is also fear index. So VIX index, when it is high, right, there is a lot of fear in the market. People are uncomfortable, so they are buying a lot of options to hedge their position. When VIX is low, so there is not much fear in the market, so options are priced less. Now we have not considered dividends while using Black-Scholes Merton model. European options on dividend paying stocks are valued by substituting. So what do you have to do? Same formula you have to use for Black-Scholes model, just you have to deduct the present value of dividends from stock price. So whatever is the present value of dividends during that option trading period, you have to deduct it from stock price S0. So substituting stock price less present value of dividend into Black-Scholes Merton model, only dividend with ex dividend date during the life of option should be included. The dividend should be the expected reduction in stock price on ex dividend date. American calls on non-dividend paying stock should never be exercised early. This is the assumption that we discussed in last class, right? So American calls can be valued by Black-Scholes model, right? Same formula that we used for calls, because there is no logical sense to exercise American call early. Black's approximation for dealing with dividends on American call options. So dividends, same thing, calculate the present value and subtract it from stock price. One important note, so the chapter ends here, but put options, American puts cannot be valued by using Black-Scholes model, because put options, it makes sense to exercise early. So that was Black-Scholes model, right? It's little difficult. Watch the video again. Whatever Excel sheet we have discussed, solve it with me, right? And see you in the next class.